Uh, you ready? This is Team Turner Solutions back to bring you part two of how taxes work. In part one, we covered which taxes come out of your check. If you didn't see it and are unfamiliar with which taxes come out of your check, then watch part one, which will be linked below. Today, we will discuss the concept behind the W-4 form. The first thing to understand is that based on your income, you will owe a specific amount of taxes. It's non-negotiable. Those taxes have to be paid, whether gradually out of your check or during the tax season for that year. The IRS goal is that the number of dependents and credits you put on your form will be the same as what you will put on your tax return, so that your taxes owed and credits received will balance out, meaning that you will not get a large refund, nor will you owe a lot. That brings us to the W-4 form. This form determines how much money your employer will take out of each check. It has preset calculations that depend on how you choose to classify yourself on the form. There are 3 filing status options: single or married filing separately, married filing jointly, or qualifying surviving spouse, and finally, head of household. Filing as single or married filing separately tells your employer to take out the maximum amount of taxes. Filing head of household lets your employer know to take out less taxes. And finally, married filing jointly or qualifying surviving spouse lets your employer know to take out the least amount of taxes. This form also gives you an option to add dependents and other credits, which both lessen the amount of taxes taken from your check. With a mini worksheet attached, you can determine how many dependents or other credits you want to claim on this form, as well as disclose any other sources of income. The more dependents you put on the W-4, the less taxes you pay out of your paycheck during the year, meaning you will owe when taxes are filed. The less dependents you have, the more taxes you pay out of your check during the year, which means you have a lower balance due and may get a refund when taxes are fixed. Another blooper? Cut! I meant when taxes are filed. Disclaimer: it is probably not a good idea to use the worksheet because it is designed for you to put that you want the least amount of taxes taken out, which will more than likely cause you to owe money when it's time to file your taxes. Once again, this is your choice. Some people don't mind gathering a lump sum to send at one time, while others might prefer to pay gradually, citing that it's easier to adjust to the money coming directly from your paycheck than it is to find the money to send later. Keep in mind that what you file in this form simply controls how much money is taken from your check. It does not mean that if you file single at work, that you can't file with spouse or claim children on your taxes. You absolutely can. Some of you might be wondering, well, what if I choose the single filing status on the W-4 and then later file with my spouse or add dependents? What happens if my W-4 and the 1040 don't match? The answer is this. The W-4 form is only for your employer to know how much taxes to take out of your check and send to the IRS or state government on your behalf. This form is never seen by the federal or state government. They do not want nor get this information.
Excuse me. What happened to cashing out?
I'm getting there. And it's all about the credits. Let's talk about them. On one side, there are taxes owed on your income and taxes paid from your check. On the other side, there are credits. There are many different types of credits, but for this video, we will discuss dependent credits because these credits go hand in hand with the W-4. The IRS gives dependent credits to taxpayers, and there are 3 different types. The child tax credit, which applies to dependents 16 and younger, and the earned income credit, which applies to dependents 23 and younger. Notice I said 23 and younger because many people have mentioned that they were told once their children turned 16, they could no longer be a dependent. That's absolutely false. They will no longer qualify for the child tax credit, but you might still be eligible to receive earned income credit or the education credit, or both, depending on your income. We will do separate videos for each of those credits because they have several factors that determine payout and eligibility. Back to claiming your dependents after age 16. As long as your child lives with you and you take care of more than 50% of their upkeep, your child is still your dependent. Even if the child lives on a college campus or an apartment or has a part-time job. And that brings us to the education credit, which applies to dependents in college, like it says. Think of these credits as free money. If a person pays enough taxes throughout the year and a person has dependents, the taxpayer can receive all the credits that apply. That brings about the big refund. But if a person does not pay sufficient taxes throughout the year, at the start of the new year during tax season, those taxes still have to be paid. The free money credits will be used to pay those taxes. So let's recap our lesson for today. Everyone owes a certain amount of taxes based on their income. The amount can be paid gradually throughout the year from your paycheck or in a lump sum during that year's tax season. Form W-4 is used to determine the amount of taxes taken out of each check. The IRS gives credits. Those credits can be claimed in advance on the W-4 or on the 1040 when filing, but not both. Available credits will first be used to pay any tax due on the overall income not paid throughout the year. Once the tax debt is paid, any leftover credits will be issued as a refund. If you've already paid sufficient taxes throughout the year, you receive the entire credit as a refund, in addition to any overage that you may have paid out of your check. Join us for part 3, where we actually fill out the W-4 form and discuss the calculation.